the final two methods that the book talks about on valuation are a lot easier, and they are actually commonly used. They're basically multiples. Okay, so you could have trading multiples, or you could have transaction multiples. And it's very similar to when you're selling your house. Essentially, how do you value your house? There really is no cash flow forecast or anything like that. You look at, what did the house across the street sell for? How do we compare to that? And let's use a rough estimate to value our house. And that's how companies often do it as well. So it's only as good as the value of the multiple. And what you want to do is you want to compare your share price, by your, I mean the company, to a company that's similar. And so if you pick an unrelated company, it's not going to be a valuable multiple and won't give you an accurate price. And by similar, you probably want to be in the same industry. The size would be the same. Not, you're not startup. If one's a mature company, you want to compare similar type of stages in life cycle and your growth prospects. So both companies should have similarities on those. So with transaction multiples and trading multiples, you can do it two different ways. You can do it one where you're calculating the enterprise value, which is what we did in APV and DCF. And the strategy here is there's a lot of different types of things you can use. You can use free cash flow as a multiple, EBITDA, EBIT, or sales. And there's others as well. An example of this would be, you would take the enterprise value of a firm divided by free cash flow, and that gives you X. Okay. So then if this number is, so let's say your EV to the free cash flow is 5.0 for a competitor, and you deem this to be a competitor that's very similar to yours, if your free cash flow is 10 million, then the company value is equal to 10 million times 5.0, or $50 million. Okay, so you can use that on any of the metrics. If you have EBITDA, sales, you just look at the comparable, and then that can estimate the value of the company. And keep in mind, what we calculated here was enterprise value. So this would be equity plus debt. Okay, so if you wanted share price, you would use this to calculate the share price by dividing that number by the number of shares outstanding. The other types of multiples are basically straight share multiples, where you don't have to do the conversion. And in this case, we're just going to calculate share price directly. And some examples of this are, let's say, price to free cash flow, price to book value, price to earnings per share. This is the most common one. This is a PE ratio, as you often hear that quoted. So an example would be your competitor has a PE of 25 and your earnings per share are $2. Therefore, your share price would be $2 times the price earnings ratio of 25. Okay, so you should be trading at $50 per share as an estimate. So you notice in this case, we didn't have to go back out debt and do anything, because we're just calculating the share price directly. Whereas in the previous one, we were calculating the enterprise value. And this is essentially the same thing for transaction multiples. The difference is a transaction is when a company has been sold, or when a competitor. So instead of looking at the daily share price, you're looking at the acquisition price. So the price for the whole company, not just the price for one of the shares of the company. And the reason this is important is because usually when you look at an acquisition price, so what the buyer actually paid for the company, it's going to equal the current trading price, which is used for transaction multiples, plus an acquisition premium. So usually you have to pay more than the current value to entice current shareholders to sell it. So this is the basis for transaction multiples, or not transactions, or trading multiples. And this is the basis for transaction multiples. And whether you have a transaction multiple or not really depends on if you found a company that was sold recently that was similar to yours. If not, then you would default back to trading multiples.